Today we're going to look at the 18-year property cycle, covering off what it is, how it works, what the different stages are and how long they last for, when the worst time to buy is, when the best time to buy is, and how you can use it to your advantage, and if you should really try and use it to your advantage at all. Stick around to the end and I'll give you some of my own advice and thoughts on the best time to buy property. Clue is now, and whether you should be putting stock in this at all. Why now? I thought it would be quite an apt time to go through this, as UK house prices have just hit a record high off the back of 0.7% growth last month, taking house prices to £300,077. Additionally, recently interest rates were held the same by the Bank of England at 3.75%, with 5 members voting to hold and 4 to cut. They said that they expect another rate cut probably around April time. That suggests a positive buying environment. Rates are coming down and prices are going up. So does this map to the 18-year cycle, and can we use it to make sure we buy at the very best time? What is the 18-year property cycle then? It is a theory that property prices move in a cyclical cycle governed by supply and demand. The model suggests that prices go through a predictable 18-year cycle following these phases. Years 1 to 7 is the recovery phase. That's after you've had the crash or the recession. So 1 to 7 is recovery. That's modest, consistent growth. Around year 7, then you have what's known as a mid-cycle wobble. This is because people are getting a bit concerned about the fact that prices have been going up consistently for 7 years and start to fear that it might be a bubble or that they might crash. Slight loss of confidence, so you have a little dip. From 7 then to 14 is what's known as the explosive phase, with the last 2 years of that, 13 and 14, being known as the winner's curse. Why the winner's curse? Because if you buy during this time, you will supposedly lose money coming through the other end of the cycle. Years 14 to 18 then are the recession phase, where prices drop and stay flat, or drop and start coming up a little bit, but it is that phase that's known as the recession phase. So if you look at the last cycle or the current cycle, this would be 2008 to about 2011-12 would have been that recession phase. So why is it important then? Why should we look at it? It allows us to make more informed buying decisions. It allows us to plan our strategies and goals. And it allows us to align timings with what we're trying to achieve. Or, as we'll see, does it really? The theory is developed by Fred Harrison, who actually wrote a book on it, Boom and Bust and the Recession of 2010. And it's not just made up. Fred Harrison is the guy that predicted the market crash in the early 90s, and he also predicted the crash of 2008, hence the depression in 2010. He's done his research, put it in a book. You don't have to read it, it's quite boring, but it goes all the way back to the 1600s, and you can actually track the cycle working and moving from then. The cycle itself can be traced back as far as the 1700s. Why then? After the dissolution of the monasteries, land became traded freely and was not just allowed for lords or landowners. Anyone could buy and sell land, and that's when we started to get the free market dynamics that would lead to this cycle. It was also around this sort of time where we saw the first recorded property booms, and the data is all there, and also the first property market crashes. What are the key drivers of the cycle according to Fred Harrison? It's the finite nature of land. It's the availability of credit and the cost of it, i.e. interest rates, hence why interest rates coming down is interesting. And then it's the bank's willingness and ability to actually lend to people. And again, in 2008, or the build up to that, there was a massive willingness to lend, subprime mortgages, which is what actually led to prices firstly going up and then the crash. The phases then in a bit more detail. The recovery phase, this is years 1 to 7. Prices bottom out from the previous peak. Lending is tight and finance is difficult to obtain. Cash buyers can come in and secure good deals. Banks are cautious about lending because they're scarred from what's just happened. And some buyers are still cautious about buying, even though technically it could be the best time to buy. And then you've still got some sellers selling out of fear because they think the end is nigh and prices will keep falling. If we're trying to look at the current cycle and where that might be, you could say the recovery phase would be 4 years after that 2008 crash, so 2012 up to say 2019. And the data shows that house prices actually rose around 41% in this period, which may suggest the theory holds true. The mid-cycle dip then in or around year 7. Why is this? people start looking back to the previous crash and think, oh, is this going to happen again, as prices have been going up? So people are still a bit cautious and get a bit fearful and take their foot off the gas a little bit. The exciting phase, or the explosive phase, this is rapid growth from years 7 to years 14. That's broken down even further into 5 years of rapid growth, and then the final 2 years are what Fred Harrison calls the winner's curse. More on that in a bit. The characteristics you'll see: rapid price growth, easily availability of lending, positive news in the media, everyone's talking about house prices going up, and then a growing FOMO, or fear of missing out, and people jumping on the bandwagon. This will potentially be supported by the fact that from April 2020 to April 2021, we saw an average growth of over 10% in the UK, with some places growing 12 to 14%. Now, this is where the current cycle starts to get a little bit skewed, because we've never had a black swan event such as COVID to analyze, which a lot of people say may have been skewing the 18-year cycle. So where are we really? More on that in a second. The winner's curse then is the last 2 years. It's frenzied buying. It's people getting gazumped on deals. It's everyone at the pub and all your mates talking about buying property, and buyers getting in and paying any price to secure a property because they think it's just going to keep going up and up and up. And then there comes a point where the confidence eventually breaks, as we saw in 2008, and we move into that recession phase. I'll go through that. Most people know what a recession is, but falling prices, tightening lending conditions, banks don't want to lend, forced sales from over-leveraged or over-mortgaged buyers, which fire sales, coming onto the market cheaper, which has more downward pressure on prices. And again, this holds true if you look at this current cycle, or the last one, 2008 to 2012, saw house prices increase by just £10,000, or an average of about 1.6% per annum. So where are we now? Who knows? If you look at the current cycle, then we are 18 years from 2008, which would suggest that we've just been through the explosive phase and that we're about to enter a recession phase. But if you look at the data, yes, house prices have hit an all-time high, but it's not necessarily been explosive, has it? It's been pretty flat consistently over the past few years, with interest rates being the way they have. In addition to that, if you look at real house price values, so house prices adjusted for inflation, we had those few years, 2023, for example, where we had inflation running at over 10%. What's actually happened on inflation-adjusted house prices is that house prices have been falling from March 2022 in real terms, which is pretty much 4 years ago. And that made me start thinking, well, maybe we experienced a shortened cycle because of COVID and these strange black swan events. And actually, if we have had 4 years of real house price losses, then actually maybe that's our recession phase and we're coming into a new growth phase now. And then when you stack that with the recent news, house prices hitting all-time highs, interest rates coming down, banks' willingness to lend, which is there, a new 98% mortgage from Santander shows banks willing to lend. To me, the conditions of what you're seeing in the market would suggest perhaps we're set for growth. So it's a bit confusing, and that is why I personally don't think, shock and horror, you should put much stock in the 18-year property cycle. If you are buying property for the long term to build wealth, then as long as you're not buying, as Fred Harrison says, in the winner's curse, you're going to make money long term. And actually, if you look at the data from 2007, 2008, even people that did buy in the winner's curse, the places that dropped the most in value were back to break even 10 years later. And property is a long-term game now more so than ever, with increased sunk costs, stamp duty, for example, as expats. So you should be buying as soon as you possibly can based on your goals and when you can afford to do so. The data suggests that if you're buying and holding for the long term being 10 years plus, it doesn't really matter when you buy. And if you get caught up in wanting to sit on the sidelines and wait for a crash or wait for the right time to buy, then you're going to be missing out on heaps of rental income as well. So you are shooting yourself in the foot almost. I personally don't follow the 18-year cycle and make buying decisions on it. I don't really think you should either. It's a bit of fun and interesting to look at. And as with anything in life, it's good information that will help you make informed, intelligent decisions. So what would be the key takeaways here? Base buying decisions on market and area fundamentals, not market sentiment. Ignore the hype or the headlines in negative or frothy market times, something I wholeheartedly agree with. Headlines are very negative or very positive. There's nothing really in the middle. Focus on the income side of things as well, which a lot of people overlook, not just the capital growth, because the 18-year cycle is all about capital growth, i.e. house prices. Income from property is a great way to make money and create a passive income regardless of what prices are doing. Waiting for house prices to fall can cost you years in lost rental income, something to consider. And lastly, if you're buying property with a mortgage, which most investors are, you are getting a leveraged return on your money. So actually, even if house prices are not growing that much or they're flat, then the leverage return on your deposit will always be much higher, and the same for the rental income. If you'd like more information on how to plan, build, start, and grow a property portfolio as an expat living in Asia or overseas, then grab a copy of our book, 10 Steps to £10,000 a month with UK property. And you'll notice not one single mention of Fred Harris or the 18-year property cycle.